You would have studied the accounting cycle in Introductory Financial Accounting. However, if I asked you now, today, it's unlikely you would be able to list off the steps in the accounting cycle. This is further complicated by the fact that, depending on which textbook your institution used, the number of steps change. Some textbooks list only 6 or 7, others more, others less. So let's just answer the question, what are the steps in the accounting cycle? Step 1. Analyze transactions. That would be using the accounting equation and the financial reporting elements: assets, liabilities, equity, revenue, expenses, gains and losses. Step 2. Journalize transactions into the general journal. Step 3. Post the journal entries into the ledger accounts, also called T accounts. Step 4. Prepare the unadjusted trial balance. That's what we use to determine the adjusting entries. Step 5. Journalize and post adjusting entries. We're going to talk about that in a little while. Step 6. Prepare the adjusted trial balance. It's the adjusted trial balance that we use to produce our statements. Step 7. Prepare the financial statements. Note that if we were producing interim financial statements, the cycle would stop right here. For instance, month-end financial statements wouldn't go any further. However, for the year-end financial statements, we would go to Step 8, Journalize and post the closing entries. Remember, this is for year-end only. Step 9, prepare the post-closing trial balance. This is to ensure that all the closing entries were made appropriately. And Step 10, journalize the reversing entries. This step is actually the first step at the beginning of a new cycle, but we list it as the last step because it's not required and it's not taught in Introductory Financial Accounting. However, reversing entries are the very first thing we do before we start analyzing the new transactions for the new period. Since steps 1 to 9 are covered in Introductory Financial Accounting, I won't be covering them here in detail. Instead, I'm only going to focus on Step 5, Adjusting Entries, and Step 10, Reversing Entries. A detailed understanding of adjusting entries is a critical component of any month-end, or quarter-end, or semi-annually, or year-end process, and it should be understood in detail. Students often struggle with adjusting entries in Introductory Financial Accounting, and I'm going to make it even more complicated. How so? Because in the upcoming videos, I'm going to cover all of the following: why adjusting entries are required and the 5 different types of adjusting entries. This is a bit of a review. The balance sheet method of recording adjusting entries without reversing entries. That's from Introductory Financial Accounting. The balance sheet method of recording adjusting entries with reversing entries. That's brand new. The income statement method of recording adjusting entries without reversing entries. So the income statement method is a totally different method that I really want you to understand. And E, the income statement method of recording adjusting entries with reversing entries. Again, increasing the level of complexity moving forward. We're going to start with A and B. Both of these will be familiar from Introductory Financial Accounting, but I'm going to complicate it a bit and make it more realistic. Everything else is likely going to be new to you, so it's a lot to cover. Let's get started.